Welcome to the screencast on IAS 37 Provision, Contingent Assets and Contingent Liabilities. My name is Yumna Abed and I'm a senior lecturer in the Department of Financial Governance. You can email any queries regarding IAS 37 to fac1postgrad@unisa.ac.za or for level 2 fac2postgrad@unisa.ac.za. Now let's look at IAS 37 Provision, Contingent Liabilities and Contingent Assets. You can expect discussion or calculation type questions for IAS 37. Let's look at the definition of a provision. It is a present obligation, either legal or constructive. There's a probable outflow of resources and there's a reliable estimate. It's almost a liability except there is uncertainty on timing and measurement. If you look at a contingent liability, there's a greater measurement of uncertainty. This is actually a possible obligation, not a present obligation. And from past event whose existence is confirmed in future, the timing is not known, and we can disclose this in a note. Contingent liability or contingent asset is disclosed in a note. And you need to look out for onerous contracts. An onerous contract is a contract in which the unavoidable costs of meeting the obligation under the terms exceed the economic benefits expected to be received under it. Let's look at an example. Bats Limited was contracted to provide 500,000 pairs of shoes to a once-off customer over 2 years for a fixed price. At the end of year 1, after 150,000 pairs, the price of the raw materials increased. We are unable to renegotiate the sales price, and if you cancel, there's a 500,000 penalty. The total cost to produce the remaining pairs is 4.1 million. The total price received for the remaining pairs is 3.5 million, and the discount rate before tax is 10% per annum. The remaining pairs will be delivered 12 months after the reporting date. Now the question is, should a provision be raised at the end of year 1? Now, the question is, what gives me an indication that the contract might be onerous? Is the contract actually onerous? If you look at these specific indicators, the fact that the price of the raw material increased and the fact that they're unable to renegotiate the sales price is the first indicator. The second indicator, the more obvious indicator, if you look further down, is that the total cost to produce the remaining pairs is 4.1 million. However, the total price received for the remaining pairs is 3.5 million, which means that the costs exceed the economic benefits to be received under this contract. So if I have to ask you a theory question based on this, you would say that the obligating event is the signing of the sales contract, which gives rise to the legal obligation. Once the sales contract has become onerous, an outflow of resources is probable, and the amount can be estimated. As the contract is onerous, a provision should be raised for the present obligation of the contract or penalty. So your provision should be raised at either the lower of the present obligation of the contract or the penalty. Now let's look at how to calculate the present value, the present obligation of the contract. We had a cost of 4.1 million and the total price to be received is 3.5 million. So we're going to be taking the 4.1 million minus the 3.5 million, which gives us 600,000. There's only one period remaining. The 10% is your interest rate. If I had to say your discount rate after tax is the following, you would need to calculate an interest rate before tax. Remember, we always use our interest rates before tax. That gives me a present value of 545,455. Now, because my penalty is lower than my present value, I am going to be taking the lower of the two, and therefore my provision will be raised at 500,000. For my journal, I would be debiting my operating expenditure of 500,000, and I would be crediting the provision for onerous contract. Now let's look at some exam technique on provisions, contingent liabilities, and contingent assets. Because if I ask you a theory question on provisions, contingent liabilities, and contingent assets, I would like you to have the proper exam technique in order to pass that particular question. The first thing that you need to always do is state the obvious. For example, if the previous question was a theory question, you would mention the fact that the price of the raw materials increased. That is an indicator that the contract might be onerous. Before you start, read the required again. Make sure you understand exactly what is in the required. Before you start, ask yourself, what are the important issues I need to address? You need to plan your questions properly. When answering the question, make sure you address all of the relevant issues. Remember to integrate with standards. Only if you can see it is necessary. Do not include other standards that are not necessary. For example, I give you a question on provisions, contingent liabilities, and contingent assets, and there's absolutely nothing regarding leases. And then you put the leases standard in there. Obviously, you will not be able to get marks for the leases standard that you've put into the provision, contingent liabilities, and contingent assets theory question. Now, another thing that I cannot emphasize enough, guys, is apply, apply, apply. You will only get marks for your application of the theory. I will not give you marks for any information that has just been thrown in from your standard onto your paper, okay? You need to apply all of the information in order to get the marks. You need to use bullet points, you need to write concisely so that I can see what you're saying in your paper, and you need to write to the point. Remember, guys, you must always conclude in a theory question. Thank you guys so much.